rough week for the banking industry.
The collapse of Silicon Valley Bank is causing shockwaves across the
Hello
entire
and
business
welcome
world.
to Top Trends Online. Today we will be talking about the collapse of America's major banks like Silicon Valley Bank. Bank collapses and runs. Is the U.S. prepared? The collapse of Silicon Valley Bank has raised concerns about the stability of the U.S. banking system and whether bank runs could be a possibility in the near future.
And I'm just wondering if in your mind the investment thesis or paradigm has changed at all as you get your arms around what may happen next in terms of more regulation, higher interest rate on deposits, which has an obvious and immediate impact on net interest margin.
Meanwhile, Signature Bank marks the third largest bank failure in U.S. history. Regulators say all customer deposits will be insured in that case as well.
The question remains, is the U.S. prepared for a potential banking crisis? Bank collapses and bank runs have been common throughout history. The U.S. has already lost about 80 banks this year, but depositors have been safe so far. Bank runs occur when depositors demand their money back all at once, creating a rush on the bank. These runs can quickly cause a bank to run out of cash and collapse, leaving depositors with nothing. Such scenarios have occurred in the past, including the famous run on banks during the Great Depression in the 1930s. But could it happen again today? As mentioned earlier, banks collapse quite frequently, with the failure of Washington Mutual in 2008 and the Bank of Credit and Commerce International, BCCI, being just a few examples. The failure of WAMU was due to bad real estate loans and a full-fledged bank run in which depositors withdrew over $16 billion in September 2008. This highlights the fact that bank runs in America can and do happen. Fortunately, depositors have not lost their money in recent years, but this could change in the future. It is important to note that bank depositors are protected, but to a limited amount. The FDIC backs the full amount in non-interest-bearing accounts, such as savings accounts, according to the new rules posted on November 9, 2010. However, the protection seems to disappear on December 31, 2012. Interest-bearing accounts and other accounts are limited to $250,000 per depositor. This limit could change at any time, and the FDIC.gov site is the place to get the latest information. In today's climate, a bank collapse could be due to one of two factors: bad real estate loans or exposure to derivatives tied to conditions in Europe. The former has taken the worst toll so far on American banks, but the latter could become a significant problem in the near future. Bank of America, along with J.P. Morgan, Citi, and Goldman Sachs, control about 95% of the $235 trillion derivatives market. If there is a problem in the derivatives side of one of these banks' balance sheets, then the whole bank is at risk. This means that depositors are also at risk. The escalating tensions between Russia and Ukraine, along with the increasing sanctions imposed by the U.S. and Europe, could further destabilize the global financial system. As mentioned earlier, a significant portion of the derivatives market is held by U.S. banks, and any significant disruption in the market could cause a chain reaction of bank failures and bank runs.
This place all wrong, as if I had the money back in a safe. The money's not here. Well, your money's in Joe's house, that's right next to yours, and in the Kennedy house, and Mrs. Maitland's house, and 100 others.
In such a scenario, the FDIC would be out of money, and depositors would be left with nothing. In conclusion, bank runs are not a thing of the past, but a possibility for the very near future. The U.S. has already lost about 80 banks this year, and the ongoing financial instability in Europe, as well as the escalating tensions between Russia and Ukraine, could further exacerbate the situation. While depositors are currently protected by the FDIC, these protections may not be enough in the event of a significant disruption in the global financial system. It is, therefore, essential to keep a close eye on the situation and take proactive measures to protect one's finances, such as diversifying one's investments and keeping a portion of one's savings in cash or other non-financial assets.